our first speaker, who's Julio Faura. Julio, before founding Adara, was very involved within the blockchain space at Santander. He worked there for 11 years, but pioneered, like I said, a number of the different initiatives that they were working on. And has certainly, given his expertise, has gone very kind of deep with the different technologies and platforms. And this knowledge really put him in such a great position to be involved, found along with a couple of others, Adara. From a finance and banking perspective, plus blockchain, he's got a fantastic amount of expertise there. And I think he'll be able to just shed a lot of really interesting perspective on the challenges associated with these digital currencies.
Yeah, as Connor was saying, I did spend a lot of time working on blockchain when I was the other side of the table, working for Santander for 11 years, McKinsey before that. And my background is a little bit more technical than that. I used to do chip design. I am a chip designer. I did a PhD in computer science and electrical engineering, and then changed to management. Went to MIT to get an MBA, and then anyway, now I'm very happy to be able to marry my technical passion with the what's happening in the financial industry, which is a very interesting combination, as you all know. Now, today, I'm going to tell you a little bit about what we are doing in the space of CBDCs, particularly wholesale CBDCs, and also the creation of digital currencies through commercial banks as well, commonly referred to as commercial bank coins, right? And how they can be used in payments, right? It's very central to what we're doing in Adara and the different initiatives that we are involved with. In order to talk about digital currencies, I find it's useful to first talk about what is a currency, right? And what is money, really. This breakdown actually comes from a research paper written by Tony McLaughlin from Citi. It's a quite clear piece that try to state the main issues, the main challenges, but most importantly, what are we talking about when we talk about CBDCs and tokenized money? So essentially, there are 4 types of money in the world. Only one of them is physical, which is cash, right? It's physical cash, but that's really small. That's about 3% of the world's money. Most of the world money is actually bank money, right? And this is bank that is created by banks. These types of money, so bank money, electronic money as well, which is available in some jurisdictions, and central bank money, I'm referring to central bank deposits, which are for wholesale use only. Those are what we would call regulated liabilities, right? So bank accounts account for the majority of the world's money. It's legally binding, so it's can't free up debt. The same as physical cash and other forms of money, but it largely accounts for the majority of the world's money. Most of this money is created against credit, right? And this is something that many people don't know and even don't believe when you explain, right? So essentially, you go to a bank, you ask for a loan, and at that time, the bank is going to create the loan and it's going to create the money. Essentially, they will add the balance to your account. And that's how money is created. So the guarantee for that money, or what the backup, if you want, for that money is the loan, right? So a lot of the world's money is created against credit assets that banks have in their balance sheets, right? It's important to understand. I mean, the money is not lent by the central bank. The money is not created by the central bank and then distributed through commercial banks or anything like that. There is a small amount of money that central banks provide to commercial banks, and even in this case, these things are liabilities for the central banks. So they are acquired by the commercial banks, trading that for repos. I mean, for government bonds or for other types of liabilities, but most of the world's money is created as bank liabilities, right? By banks as regulated liabilities. Now, most of this money, the same as central bank deposits and electronic money accounts, all this money is actually digital, right? It's actually digital. It does exist in digital form. It does not exist in physical form. The only thing is that those digital balances are created on bank systems, and therefore it's not what we would call programmable money. So it's difficult to access, right? The bank will not open an API for you to horse around with your with your bank account balance, right? So it is digital money, and the same happens with electronic money and with central bank deposits, right? So if you know, after all this, then what is really a digital currency? Well, a digital currency is, well, at least the way we understand it, there's you know, there are two main things that are you know, quite interesting right now, and a lot of people talking about, which is retail CBDCs and well, wholesale CBDCs and bank coins. Retail CBDC is supposed to be an alternative to physical cash, and therefore many people are considering that a type of a bearer instrument, right? While you know, wholesale CBDCs are you know, a kind of a digital way, if you want, or a more digital way to produce central bank liabilities, so essentially a substitute for RTGS systems. And bank coins are essentially the same thing as bank accounts, only that I mean, the key for all these digital currencies, at least what we commonly refer to as digital currencies, digital means programmable. So essentially the ability to couple functionality with money, right? Of course, an optimal implementation of that can be done through smart contracts and blockchain. And Ethereum, I think, is done actually a pretty good job in conceptualizing all these possibilities and making smart contracts available to people and to developers. So it's quite important. Now, in our work and for, you know, in this session, we're going to be talking about this part here, right? So essentially regulated liabilities, not bearer instruments. Bearer instruments like physical cash and some forms of retail CBDC that are being researched today have quite important problem, which is AML and counter terrorism financing issues, right? Particularly cash. It's a big concern. It's one of the reasons why it's trying to become marginalized as much as possible, right? And CBDCs done in a way that are not linked to digital identity would suffer from the same problem, at least in our thinking, right? The problem of linking digital identities to retail CBDCs or to digital currencies. The issue with that is that then someone needs to do that, right? Someone needs to do the KYC and all that, and all that is done by banks today. So the appetite by central banks to replace the banks and start issuing this money, bearing all the work, right? All the you know, doing all the heavy lifting of keeping KYC current and all that. You know, it's a big thing, and I think it's a reason for central banks to really not try to pursue that. That strategy. The other one, of course, is the nature of the bank money, which is created against credit, right? If we start creating money by central banks against credit, that means that the central bank will have to start giving credit to people, and again, that's a very big heavy lift that would change a lot the way the world works today. So at least as a first step, we are focusing on this part, which is not changing monetary policies, not changing anything. It's just changing the systems that are used in order to produce central bank money. So essentially through wholesale CBDCs or bank accounts, right? Essentially through bank coins. But it's the same thing. It's just doing, you know, the same thing the banks or the central banks do today with their systems, but instead of using classical systems, instead of that, well, using smart contracts on blockchain, which produces the same type of money, but programmable, meaning the possibility to couple functionality with the money itself. And there are two main forms to do this, right? What we would call as native regulated liabilities, and the other ones would be tokenized. Native is essentially using the smart contract as if it were your core banking system. So you give it a loan, you create the money, and when you create the money, you just do it on top of the smart contract instead of doing it on top of your core banking system. That's what we would call a native CBDC or a native bank coin. The tokenized construct is using the electronic money construct, which means using a backing, right? A backup or an omnibus account as a backup. And let me try to explain. I mean, probably everybody will be familiar with this idea, but the idea is essentially that the issuer of the CBDC or the tokenized money would have an omnibus account at the RTGS system if it's a CBDC, or at the bank if it's electronic money or a bank issue, right? So essentially, imagine that you are a bank, you have an RTGS account at the central bank, you can transfer money to your omnibus account, and then the issuing institution is going to create the digital money here in the token smart contracts, essentially a digital balance for you. And this digital balance is really a digital representation of the money that is held here in the omnibus account, right? So this is a backed construct. This is what we commonly refer to as a tokenized construct, right? So probably an abuse of the term tokenized, but that's normally what we refer to, right? So essentially the money that is created here is created against an asset that the issuing institution is going to have in an omnibus account. Now, in central bank money terms, this is starting to be legal now, right? Probably you are aware of the announcement that the Bank of England made a couple of months ago, stating that now there is a policy to actually use RTGS accounts as omnibus accounts exactly for this purpose, right? In the case of other jurisdictions like the US and the ECB, you still need to be regulated, although it looks like there's no need to actually apply for this access policy, right? So it's a little bit easier. But in the case of Bank of England, this is quite historic because it's making essentially the previous construct that you just explained, it's making it legal, right? So it's quite exciting. What we are just to so all this is it makes sense, but why is this interesting, or what are the issues that can be solved with this type of construct, right? We were talking about programmable money as being the key for all these digital currencies. Well, let's illustrate this, for example, in the case of payments. The case of payments, as you know, when you do international payments, you're familiar with this situation. You essentially have domestic banks that do not talk to each other directly, right? They go through correspondent banks. There's a lot of messages involved. And typically you need a different number of correspondent banks involved in the middle. And that has a few issues, right? First of all, there is no digital orchestration payments, no digital orchestration layer for payments, right? Because all this is based on messages. So payments are not created as single digital objects, right? There's no good way to do the orchestration of the payments. And FX is not really part of the payment process. That is dealt with separately. And because of all that lack of orchestration, and because of the fact that the actual repositories of money are either on banks or within central banks, then there is a separation between the trading process, right? So all the payments process and the post-trading process, meaning the settlement process. So essentially, all these banks start to send messages around, and at the end of the day, they will stop and do a reconciliation, right? They will try to see, okay, how much money do we owe net each institution to each other institution, right? So that process of reconciliation is quite costly, right? And it does have operational risk because there are mistakes that it can be making. There's a lot of manual process in the middle, particularly in emerging economies. So it's a relatively big problem. And again, this is because of the decoupling of the payments process, all this orchestration process for the payments and settlement, which just happens on the accounts, right? And finally, there's a problem of fragmentation of liquidity and credit counterparty risk. Essentially, every time you do a payment, right, between all these institutions need to have an account with one another. So because this bank is going to have to pay this bank is going to pay that bank is going to pay the other bank. And in order to do that, each bank would need to have pots of money with the other institutions. And I know banks that would have like for 5,000 of those accounts in other banks, right? So it's very, very difficult to manage. It leads to fragmentation of liquidity. There's a lot of liquidity deployed in the system. And very importantly, a lot of those levels of liquidity are actually deployed on other banks, right? It's called the Vostro construct, essentially banks that have accounts with other banks that are called Vostro accounts. And that has counterparty risk, right? So that has, that is costly, it's difficult to manage. And also another important point, which is the lack of visibility. Essentially, at any given time in a given point in the day, you just don't know how much money you have because you don't know. You cannot be looking up all the balances, right? In all these different repositories of liquidity, and you don't know how much money you will need to settle the bulk of the payments that happen throughout the day. So it is difficult to know at a given time, at a given point in the day, how much money you owe or you're going to be paid. So therefore, you don't know how many euros and pounds and dollars and Singapore dollars and rands and whatever you have in your portfolio. You just don't know how much of that you have at a given point in the day. So that makes it difficult to do risk management. You just don't know how much you have to hedge until you go to the end of the day. And that's a little bit late in the day, right? Because you cannot, for example, do dynamic pricing. You cannot offer dynamic pricing to clients. Right? So digital currencies actually provide a different way to solve these issues because essentially, first of all, you can create business applications to do, well, orchestration of all these processes. For example, creating payments as single digital objects, as we were just mentioning. And then you can couple those things with the money, right? If you create the money programmatically here using smart contracts, you create those digital balances. Essentially, you can couple a lot easier. It's a lot easier way to couple the business applications with the money itself, right? So the programmable nature of the money actually allows you to do this coupling, and it also provides you with better visibility and accessibility. Instead of having to go through bank APIs or central bank APIs or something, you can just plug a node, and then with the right level of permissioning, obviously, but everything is secured with the with public key security with public key cryptography, right? As in public blockchain networks, as per the blockchain constructs that we're all familiar with. You can essentially operate with that money very easily. It can be argued that all this can be done without blockchain. It is true. It's just that smart contracts and blockchain is a very cost-effective way of doing it, right? First of all, the decentralized infrastructure provides settlement finality. It provides resilience at a very good cost, right? And it provides bank-grade security, right? So this is extremely cheaper in comparison to banking-grade solutions to do this. Right? Because essentially, you would have to secure all the access to the money repository using classical terms, and that's a lot of money spent on cybersecurity measures. Right? So that's the big thing, and the benefits are clear, right? So first of all, you have a lot more visibility on liquidity. You can couple more applications with single repositories of liquidity. Therefore, you can reduce fragmentation. You can reduce counterparty risk if you go for CBDCs, right? For central bank backed cash or central bank issued digital currencies, essentially because they have no counterparty risk. You can avoid, you can ensure atomic settlement in real time. So essentially, when you create the payments, you can do the clearing of the payments in a perfect manner. So when you start a payment, you can put whatever liquidity you need to settle on hold, and therefore have no settlement risk when the payment finish, right? There's something called the settlement risk, which means essentially you can start a payment, and by the time you finish the payment, if one counterparty does not have enough money to pay the other counterparty, then settlement cannot happen. So that is the risk of that happening is what's called settlement risk. Well, with these constructs, you can couple the payment process with the money itself. So when you start a payment, you can clear the payment, you can put the liquidity on hold here, and then when you finish the payment, you can atomically settle the transaction very easily, right? And then you can expand the benefits to end clients as well, because, for example, corporate payments, so corporates, large corporates, and even retail users, they could be interacting with their money a lot more freely by being part of the decentralized network. So again, they don't need to go through bank APIs in order to visualize or to use their money. They can do that through blockchain means. What we're seeing now in the market is that there's a lot of chatter about CBDCs and tokenized money, mainly because the first platforms are quickly advancing towards production. And Finality is probably the best example, as you probably know if you are following. So it's a very advanced system, and we are seeing all these regulatory announcements, including the approval of the access policy for omnibus accounts by the Bank of England, and there will be more announcements going forward in the rest of the year, in the coming months. And also there's a lot of research and even practical experiments as well by central banks directly doing wholesale CBDCs with the direct issuance model, right, the native model, and a lot of talks about retail CBDCs, although I would argue that that's mostly research at this point, given all the very severe implications that this can have on the whole stability of the system and also the monetary policy. As soon as these things start to become a reality, then what we are starting to see is a shift in the focus towards the creation of the platforms that are going to be using this for settlement, right? So like those payments orchestration layers that we were talking about, and I'll explain about that in a minute. So essentially, the creation of the first applications that are going to be using CBDCs and other forms of central bank tokenized money to achieve all these benefits we just talked about. And the other thing that the availability of or the advancement in CBDCs is triggering is the appetite by the commercial banks to explore the creation of intra-group solutions for liquidity management and payments based on tokenized liquidity. So that's what we normally refer to as bank coins. So essentially the ability to use those type of constructs in order to provide means for settlements for branches and subsidiaries in the banking group, right? So let's explore those a little bit more in detail, right? So in terms of applications to interbank payments, you essentially can start creating applications like this. First of all, you would need an issuer of a CBDC, right? Typically, it has to be a CBDC, and it has to be a central bank thing, because banks today are already using RTGS accounts and central bank money for interbank settlement to the extent they can, because of the lack of counterparty risk, as we explained before. Precisely, the point is shifting to this type of architectures instead of using correspondent banking Vostra accounts, right? We do have counterpart to this. So essentially, you would need someone to do this job, right? And they would be issuing CBDCs on a tokenized form here on a smart contract. Then you would provide also, we would create a payments orchestration layer. Again, another smart contract. In our construct, we call it the payments manager smart contract. This is managed by a payments scheme, right? So payment scheme operator would be managing that and essentially providing a rulebook for all the parties to interact through that. And also an FX orchestration layer, which would be part as well of the payment scheme. So this is the place where different market makers would be issuing prices, quoting FX prices, and ensuring the possibility of using different digital currencies in all these payments processes, right? So then you would have two type of factors. You would have domestic banks that do have FX capabilities that would be doing market making and providing FX rates between their domestic currencies versus bridge currencies, typically US dollars, maybe euros in some other jurisdictions. Some jurisdictions like Africa and Eastern Europe and places like that. So, these treasuries of these banks would be providing those rates. And then GTB departments would be using this for payments submission and acceptance, right? Essentially, it will be able to send payments, create the payments as single digital objects in these payment orchestration layers and these smart contracts. When they create the payment, as I explained before, whatever liquidity is needed in order to do the bilateral settlement between the participating banks is going to be put on hold here. And when the receiving bank does all their AML processes, sanction screening, whatever it is, then the payment is going to be finalized and the settlement is going to be triggered atomically. So with this, you can achieve a perfect coupling between the payments process, including the FX process as well, and the settlement process, which is going to happen in tokenized liquidity. From a legal point of view, this is exactly the same as having an RTGS account. Well, not exactly, but mostly the same as having an RTGS account. It's just that it's only issued in tokenized form, meaning that it is programmable and can be coupled with the payments orchestration layer. Right? Conceptually, we could do this directly talking to the RTGS system, but that's, again, a lot more difficult to do, has a lot more rules, it's a lot more inaccessible, and it's only accessible to, well, less parties than if you do it through a CBDC issuance vehicle in the middle. Right? Also, you could have smaller banks that have no FX capabilities. So these guys would just be using the construct to submit payments and receive payments. Essentially, they would be having wallets as well in the tokenized liquidity facility, and they would be using that to settle with the others, but they would not be providing FX services. Right? The FX services in this case, or the market making capabilities would be done, the market making activities would be done by the larger banks that do have those capabilities. And also, finally, there's a question about who should be running the underlying blockchain network, right? Or everything can be deployed on the same blockchain network, or actually the payments orchestration could be happening in one blockchain network, or even in a non-blockchain network, or in a DLT network that is not blockchain, if you catch my drift. There are many different possibilities. And in that case, then we would have to use interoperability mechanisms to provide the coupling between the different parts of the construct. Right? All these possibilities are more and more possible and available to all of us, as you probably know from other talks. Right? So this is an example of how we would approach interbank payments in this tokenized world. Now, there is also the possibility to do the same thing if you have a banking group that has a number of branches and subsidiaries. So essentially, you would create your own version of your own CBDC, like your own internal RTGS system, if you want, right? So you would designate one of your branches or one of your headquarters geography to provide a liquidity hub for all the branches and subsidiaries in your portfolio. This avoids the need for all the branches having crossed Vostra accounts with all the other branches, for example, right? Or even having to go through correspondent banks that very often are different, right? So essentially, one bank with one subsidiary in one country using one correspondent bank and another one using another one, and doing all the payment flows between them through the correspondent banks, right? That's very inefficient, and there's a lot of banks suffering with that. Well, with this construct, you can create a liquidity hub for all your settlement processes. Well, first of all, to the funding of your branches, right? Second, you can use it to do settlements of your payments, or whatever settlement needs you have between your branches. Particularly the possibility to do all the payments orchestration and therefore start creating your payments as single digital objects and avoid any kind of reconciliations needed between your two CBDCs. We've seen many banks are struggling a lot with that, right? And also, it's important to note that all these things work 24/7 and in real time. So you can provide real-time payment services. You can do your payments in real time. You can finalize them. You can quote dynamic FX prices, because you can see at every moment in time what's your liquidity balances, what are your payment commitments. So anyway, you can get all the benefits from the construct, but within your banking group. Right? This this is in general quite interesting. And the reason why blockchain is more efficient than trying to do this with conventional technology is that it is a lot easier to connect, right? If you have a banking group with many subsidiaries and branches, in general, it's difficult to connect one branch with the other, right? Because one of them is going to have to host an application for the other. You're going to have to open input ports, for example. So the connectivity is always difficult. And in this construct is easier to connect because essentially you can do your core banking system integration with a gateway that then just connects to a blockchain node, and all that happens within your firewall, right? And then the blockchain node is the only thing that connects to the external world, and that is done through a protocol that is well proven and tried out, right? Essentially the same protocol that's used in with public networks and cryptocurrencies, and that has not been broken to date, right? So it's a lot easier to do. You can essentially interact with the other branches and hubs and headquarters and all the other parts of the organization. You can interact through the blockchain and not having to do direct connections, which are very, very expensive. Okay, I know we're up in time. Just to finalize, it's also interesting that the possibility to actually extend the benefits to final clients, particularly corporate clients. So imagine when you extend the possibility to them, essentially they can fire up their own blockchain nodes and then interact with the system directly without having to go through bank APIs, right? So imagine a corporate that can, first of all, visualize in real time how much money they have in different treasury accounts. They can actually submit payments, right? They can do better applications, more advanced applications like cash pooling or whatever. I mean, they don't need to ask the bank every time what's the status of the payment, and they can instruct their payment instructions. I mean, they can send the payment instructions directly on the payments manager. They can see the status in real time. They can see the FX rates in real time in advance before submitting the payments. So essentially, it's extending the benefits to the clients. This is not changing the nature of the relationship between the banks and the corporates. We're not opening it up. We're not. It's not changing the nature. It's just making it easier to connect, right? Again, and just to finalize, I think the overall benefit is better connectivity, really, right? It's easier way to connect, better connectivity, and more cost efficient, more secure, cheaper, and that's essentially it, right? Again, when we're using this tokenized money legal construct, which is just the same way that money is created today. I think I'm going to stop here. Don't know if there are any burning questions, or we should go to the next topic.
Thanks, Julio. So we'll open the floor up for questions. We do have some time for them. So Mohan did ask about slide 9. For this to work well, do banks A and B have to use the same CBDC?
Slide 9 is probably this one. Yes, so essentially the CBDC would be issued by an issuer. Imagine this is, for example, Finality, or this is a central bank issuing the same thing. So yes, they would have to have wallets there, right? The same way today when banks want to do interbank settlement through an RTGS system, they both will have to have an account at the central bank, right? So in this case, they both will have to have a wallet an account, right, in the tokenized system. It's the same thing. It's just another technology, and this is provided as a means for exchanging value, right? Essentially, they need to exchange value, one bank with the other bank. And bank C and D, the same, right? The only difference between this bank A and bank C, for example, is that bank A is doing market making and bank C is not doing market making, right? They're just using the rates that are provided by others. So yes, in this case, the banks will need to have a wallet in the same repository so they can exchange value.
Cool. And then another question, this one from Rich. Can you explain the concept, the mirror process for corporates on the blockchain? Is it just visibility into their balance with the bank? This was what you covered on the last slide.
Yes. Okay, this is a very interesting question. When we started putting together this, we figured out that using tokenized liquidity and creating tokenized liquidity is it's a major thing, let's say, for banks, right? So one possibility is that the banks create the money directly on the token contracts. So as I said before, I mean, they give you a loan, they create the money, and when they annotate that money, when they register that money, instead of doing it in the core banking system here, they can do it directly on the token contract. That would be great, because then you would not need any kind of account mirror or anything like that. You essentially look at your balance and that's your money, right? You trigger the transfer method, as in ERC20 tokens, and that's a transfer, and that's it, right? But we figured out that a first logical step would not be trying to convince banks to use a smart contract as a substitute for the core banking system, and rather use the tokenized construct, meaning that they would still use an omnibus account as a backup for the tokenized money. Now, explaining that concept to corporates is going to be a lot more difficult, right? Like, do they really understand what means tokenized money in that sense, right? So therefore, we thought, okay, maybe as a first step, it's better to provide visibility to the existing money in their core banking systems, right? In the bank's core banking system, and just provide visibility, right? Through an account mirror construct. So this is essentially another smart contract that is used only to achieve visibility, right? So we'll have a process here that would notice every time there is a change in the real balance, in the master of the source of truth for that balance, which is the core banking system. And every time there is a change, then they would be updating the balance in the mirror, right, in the account mirror, and then the corporate would be able to see what is the balance through that construct. So in this case, we would be, using the blockchain for a purpose that is not the main purpose of blockchain, which is just to provide visibility of something else. Right? The interaction with the payments manager is different, because that's really the creation of a payment instruction. So that's a real transaction that's going to be created here. But the other one is mostly to create visibility. Very interestingly, when we've discussed this with large banks, actually a growing number of them are telling us that they are actually ready to start exploring the idea of creating the liabilities directly on the blockchain. So essentially creating the real money directly on the blockchain and not having to go through account mirrors. Of course, account mirrors have all kinds of synchronization issues that you have to be very, very careful when you build these things. And of course, it's music to our ears to create money directly on digital form on blockchain. We just thought that it was going to be more digestible the other way, but the market is telling us something different, which is it's actually great.
Great. And so then another question from Francis was, would we still need the banking payment system if people can settle payments directly via smart contract?
Yeah, that's a good
simple answer.
It's a good consideration, but you see, I mean, the industry is really complex. There's a lot of moving parts, and we need to we need to push all these ideas in a way that is compatible with the systems that we have today. So we have to do things in a very incremental form, right? We cannot produce a huge problem regarding integration with other systems and all that. So essentially, we're talking about the first steps. It is true that in the long run, if everybody starts to do this, then yes, this would be a good way to transform the payment systems in the world. At least what we're doing it, the way that the market is thinking about this is without having to change the regulatory framework, right? So every time we talk about tokenized money, we're essentially talking about the same type of bank money. It's only done with a different technology, right? That's what we want to prove, right? Because if that has the same benefits as cryptocurrencies and other types of digital assets in terms of programmability and reachability and security and cost effectiveness, then we'll essentially achieve the same promise without having to ask for a change in the legal framework, which is very difficult to do and very time consuming. So so maybe a long way of saying that yes, it could be replacing it. We think more of a potential transformation because of the benefits it brings.
Cool. And then one final question on this. Again, from Tim, you mentioned the blockchain being used for something else it wasn't originally thought to be used for. Then the baseline protocol has a similar perspective. Do you think blockchains are more likely to be used as middleware in the future?
I don't know. I think blockchains and all these constructs, I think they are very good for creating the source of truth, right, for records. I think they are very good registry systems. I think there are other possibilities when you want to do communication systems, like point-to-point communication systems. Interestingly, in Adara, we have developed private channels thing. I mean, a mechanism to be able to share private information, but using the same blockchain protocol. It's based on postal services. If you in PSS, Connor will know what I'm talking about. So it's a way to be able to do point-to-point communications between two nodes, but without having to open input ports, right? The big thing, I mean, and that was one of the main problems with Constellation, for example, in the beginning, when Quorum was created. Okay, I want to send you something, but then you have to open an input port for me. And we can do it once or twice, but we cannot link 100 banking institutions and ask everybody to open ports for everybody. That's just not going to happen. So now there are solutions. For example, PSS was a good base to do that, to create point-to-point communication protocols, controlling very well where the information is going to go, so it does not get broadcasted to the whole network. And still, we can achieve this point-to-point communication, but piggybacking on the underlying blockchain protocol. I think that is as far as I would go in terms of private communication or middleware type of functionality, right? I think the core, the core benefit for this is really providing a very cost-effective yet very secure, banking-grade secure registry on top of which to record digital assets, starting with tokenized cash, but moving into others. And attaching the functionality for basic transfers. I mean, for basic transactionality on top of that. That I think for me is the core of the core of the benefit.
Thank you so much. That was a brilliant presentation and also just incredibly educational